argument that some costs are relevant in one situation, in other situation they become irrelevant. So this will give you the idea of what does it mean. So we have two scenarios here, case one, case two. All you have to do, so these items are given here. So in this case one, it is relevant or irrelevant. You need to tick that one. So I'm going to be setting up the breakout room. Meanwhile, please take a picture of this case study.
Do we need to do both cases or only one per team?
Just read case one and then case two. Just just tick whether this is relevant or irrelevant. That's it.
Okay.
I'm gonna make one breakout room since we are just 4 participants, so I'm not gonna make 2. So remember the rules for breakout rules are that you need to turn on your camera and don't unmute yourself so that you can participate and experience live group discussions. Okay? Please accept. So for those who are watching the video, I'm gonna pause the video right now. And after that, when we're discussing the solution, then we would be discussing, I'm gonna be resuming the recording. Okay, we are back after the breakout room activity. So let's discuss the answer here. So before that, let me read case one and case two for you. So in case one, the company chronically has no idle capacity, and old model B100 machine is the company's constraint. Management is considering purchasing new model B300 to use in addition to the company's present model B100. Between both model will be working at the same time. The old model B100 machine will continue to be used to capacity as before with the new model. B300 machine being used to expand production. So this will increase company's production and sales. So company's production will increase, sale will increase. So increase in volume will be large enough to require increase in fixed selling expense. So your fixed selling expense going to be increased. Your fixed general administrative overhead is going to be increased, but not the fixed manufacturing overhead. So case one, let's see the answer here. So sales increase, yes, it's relevant. Direct material increase, okay. Direct labor increase, relevant. Variable manufacturing overhead, of course. When you new machine, it increase the production. When increase in production, total production cost consists of 3: direct material, direct labor, manufacturing overhead. So variable manufacturing overhead definitely will increase. So all these direct material, direct labor, variable manufacturing overhead gonna increase. These are relevant. So depreciation is always non-relevant in either case, whether you have different scenarios, case 1, 2, so you can just say that this is universal rule. Depreciation is not relevant. So book value of model 100.
Did you say it is always not relevant?
Yeah, you can say that in decision making it is like always not recommendable unless your decision is based on depreciation saving. That's it.
We talk about depreciation of model B100 machine. We talk about the salvage value, right?
Whether it is depreciation of B300, because depreciation is a non-cash expense, plus depreciation is, with the useful life. That's it. Time gone, value decreases. It has nothing to do with production. It has nothing to do with cash flows. So that's why it is a sunk or it is not relevant.
But just to jump ahead for 1 second, sir, they are going to sell the B100 machine, right? So wouldn't it be relevant?
Scenario 1, they are not going to sell.
But in the second scenario, I jumped ahead, sorry.
Okay, in second scenario we will talk about, but first we are covering case 1.
Sure, sorry.
First scenario, okay? So book value of model 100 machine is also not relevant. Why? Because they are still using that machine, right? So they are not selling it. So their disposal value is also not relevant because they are using it. They didn't sell it. So that's why it is not relevant. Market value of B300 machine, yes, because that differ between these two alternatives. If they don't buy it, they will save it. If they buy it, they will pay it. So that is relevant. Fixed manufacturing overhead is not relevant here. Wow. Which one? Okay, yes. Not relevant here because fixed expense is not going to be increased. We just talk about that. Variable selling expense is increased, yes. Fixed selling is increased, yes. General administrative overhead, they already mentioned it is increased. So that is relevant, that is not relevant. Let's just talk about case 2. So the old model B100 machine is not the company's constraint, but the management is considering replacing it. So when you replace it, it means you need to sell it, right? So with the new model B300 machine, because of its potential saving in direct materials with the new machine, so you would be having saving in direct materials. Okay.
Sir,
Yes. David,
did you say that fixed selling expense is relevant in the first case?
not relevant. Because, sorry, yes. Fixed,
But it says that will be large enough to require. Oh, sorry. Yeah.
fixed selling expense is going to increase, not the fixed manufacturing. So that is not relevant. This is relevant.
Yeah. I understood why.
Okay. Let me clear this all here. Second one. So the B100 machine would be sold. This change will have no effect on production or sales other than some saving in direct material cost due to less waste. So scenario 2, you are replacing the B100 with B300. Only potential saving is the direct material. There is no production going to be increased, no sales is going to be increased. Here we go. No sale is going to be increased. See, not relevant. Sale is going to be same in both scenarios, relevant or irrelevant. So not relevant. Direct material saving is yes. Okay, yes. Direct labor, no. Everything is irrelevant. And because you are replacing the B100, so book value is not relevant, but its disposable value is, or salvage value is relevant, because you will sell it and use those proceeds to buy new B300. So new machine B300 cost is also relevant. So direct material, because sale is not going to increase, production is not going to increase, so direct material is going to be, direct labor is going to be not relevant. So only case 2 relevant thing is saving in direct material because it produces less waste. All other things becomes irrelevant. So that argument, in some scenarios costs are relevant, in other scenarios costs are not relevant. So you understand that? So it means the decision making scenarios, every scenario is different. So that's why we use relevant costing in decision making. We don't categorize in terms of variable or fixed cost. We just categorize in terms of not relevant or relevant.
Isn't it going to affect the general administrative overhead? Because
No. The question says all other things except this last one. This, let me here.
on production or sales, yeah, no
This
effect on
will
production.
no impact on production or sales other than some savings in direct material. The only saving in direct material. All other things remain the same. Right? So this is how we use the stuff. So let's talk about our second learning objective, which is more, you can say, entertaining and the real application of relevant costing. Number 1 is prepare an analysis showing whether the product line or other business segment should be dropped or retained. So whether we should drop this segment or retain that. So this is the decision, yes. How we can use this relevant costing in these kind of decisions? Here we go. So adding or dropping the segment, which means your production line, should we drop it or should we continue this one? So one of the most important decision makers, managers, is whether to add or drop the business segment. So ultimately a decision to drop an old segment or add a new one is going to hinge primarily on the impact of decision that will have on net operating income. So if your net operating income is increased by adding the product, you will add. If it's going to be decrease your operating income, then we drop it. Right? Simple. It's simple, right? No, it's not. Because we have to categorize on the basis of relevant or not relevant. So we need to see that even if sometimes, we will see the example here, sometimes it is less profitable or even we are operating this product line in loss, but still we will produce it. We do not drop it. If why? Because dropping will increase our loss more. Let's just see that. So we have the example, due to declined popularity in digital watches, Lovell company's digital watch line has not reported profit for several years. So Lovell is considering discontinuing this product line. So they have the scenario. The rule is Lovell should drop the digital watch only if dropping is basically increasing its profit. So Lovell will compare the contribution margin that would be lost due to the cost that would be avoided if the line was to be dropped. So look at the solution here. So this is the segment of digital watch. So the sales are 500,000. All the variable cost 200,000. So 300,000 was their contribution margin. And now the fixed expenses are, includes general factory overhead, salary of the line manager, depreciation, advertising, rent, general administrative expenses. These are 4,000. So Lovell is giving us, digital watch segment is giving us 100,000 net operating income. Should we drop it? Should we keep it? Let's just see that. So the investigation revealed that fixed general factory overhead and fixed general administrative overhead will not be affected by dropping the watch line. So these two, fixed factory and fixed administrative expense. So fixed factory and general expenses, they are not going to be affected, right? So whether we drop it, whether we keep this segment, we still have to keep those 60,000 and 30,000, 90,000, we should keep that. Okay. The fixed general factory overhead and general administrative